All-Share Index retreating once again. The Nigeria All-Share Index closed at 35,765 points, down by about 0.25%. Now, this was as a result of losses in international breweries, PZ, Owando, Guinness, and Just Breweries. Now, while leading the market gains for today were Mobil, Access Bank, UAC Nigeria, NACO, and Evans Medical. Equities at the local bourse fell further into negative territory today, as we saw banks and blue chips falling further into negative territory. Analysts say risk appetite remains weak on the back of tapering plans by the U.S. Federal Reserve and uncertainty over the outcome of Nigeria's CBN's monetary policy meeting next week. Larry Buluro, head of research at Primera Africa, joins me now to put all of this in perspective for us. Thank you so much, Larry, for joining us. And we're looking at the market in negative territory once again. Now, we do know that the market is still in a lull. Nothing seems to be reviving the market mood, as it were. But then I do know that, of course, you also know that the big focus for markets, not just here in Nigeria, is the U.S. Federal Reserve meeting, the outcome of that meeting today. But analysts here say the bigger issue for the Nigerian equities market is what is actually going on in our own domestic space, talking about the financial regulators, the CBN, the tightening measures. Nobody knows what's going to happen next week, if the CBN is going to even tighten further. Your thoughts on that?
Thanks for having me. I do agree with you, but I think it's a cumulative effect. So it's both the QE easing going on in the United States and also what's going on locally with our CBN mandates and stuff. Everyone's holding up right now. That's pretty much what we're seeing right now. A lot of clients locally are sitting on the sidelines while international is actually selling off. The sentiment from a lot of them is there's going to be some form of tapering. Question is how much. I'm of the opinion that I think they might push this out to the end of the year. Benak is supposed to make an announcement today at 2:30 U.S. time. And I believe based on what's going on in the U.S., structurally there's some issues going on. There's the debt ceiling issue, the budget deficits, there's Obamacare coming in. So, and there's a political angle to it too. So while the Fed is supposed to be apolitical, there might be some sentiment saying, hey, let's push this out till the end of the year. The Fed actually indicated they were going to start easing when unemployment, the U.S. unemployment numbers were around 6.5%. Right now it's at 7.3. So I don't see why they would want to start the tapering now. But if
when you say start tapering now, tapering by any amount, 5 billion, 10 billion?
I'm saying they'll push it out to the end of the year. But this consensus so far, it seems to be, might be less than 10 billion. Ben Bernanke is leaving at the end of his tenure, so he might want to do something right before he leaves. And this might be the only time he may be able to do something that might be impactful. The supposedly replacement, the lone candidate right now, she's pro-stimulus. So that could also factor in some of the decisions we might be seeing so far. Now, locally, like I said, there seems to be a squeeze on liquidity right now. NIBOR's up about 40% as of last check early today. Question now, and it's probably the first time too, I think Sanusi is probably going to have to really do something since the past few meetings it's had so far. CRR came out from the last meeting. The exchange rate has has depreciated somewhat. So it'd be interesting to see what he's going to do. That will change the outlook right now. Our markets, like I said, it's been flat. It's below 36,000 for the first time in a long time. Year to date, we're about 27%. We've been averaging about 31% for the year so far. It's pretty much critical times right now.
Well, let's talk about likely scenarios that could play out ahead of the meeting or even after the meeting. Next week, we might see, or general consensus is that the CBN will take more tightening measures. Perhaps not tamper with the headline interest rate, which is still at 12%. Many say the CBN won't do that, but it might dig deeper into its toolbox to see what other areas it can use or it can tighten. So obviously that creates more worry for the market as to how banks going forward, especially for the Q3, are going to boost their balance sheets, since a lot of money is being quarantined by the CBN. We've seen their vulnerability as regards the public funds, 50% of that taken off, and now many of them are so exposed. We're looking at interbank rates, like you said, spiking higher. So likely scenario, what do you, in terms of perhaps, could we see an aggressive portfolio rebalancing by portfolio managers, or how do you think this could go?
Well, for the banks, I think it's going to remain as is. I don't see the CBN, I don't see the MPC doing anything. Any additional tightening would not benefit the markets right now. I don't see why he would want to do it. We've seen the effect so far with the banks undergoing some kind of a squeeze. I should note liquidity should get a little better for the banks in the next few days. So we have a couple of bonds coming due, about 150 billion naira coming due in the next few days. FAC allocation is coming in the next few days. So that's around 650 billion.
But that could be just a temporary easing of rates. What happens when all of that dries up?
Good question. Now, and that's, I think, we'll get to find out when the MPC guys meet. So, but I'm of the opinion I don't expect any more tightening right now because it's pretty much affecting our markets. Okay,
talking about value, let's come back to the sectors of the market. Financial services, obviously, it's usually a more vibrant sector, but a lot of uncertainties right there. But then, of course, investors could look to defensive stocks, consumer goods, industrial stocks. But of course, many of these companies deal with the banks. They're now going forward have to face or cope with a tighter interest rate environment. So, it looks like the fear or uncertainty is actually across the board.
Of course. Now, it trickles down across all sectors. So, like you mentioned, the consumer space, the industrial space, have to go to the banks to raise the facility. But banks will come back to you, hey, listen, we're tight. I'm going to have to charge you an extra couple of bips on whatever facility I'm going to give to you. So, it's a very circular issue. And I think that will also be on the table during the Fed meeting in the next few weeks, and I think they'll probably consider that in whatever decisions they're going to make. I'm of the opinion tightening is off the table. I just don't see them doing that right now.
Okay, from perhaps either from the banking sector, the consumer sector, industrial stocks or sectors, what stocks do you think investors could fall back on in these trying times, as it were?
I still think there's still some value in some of in all sectors, some of the banking sectors. So a GTB, a First Bank, currently. Fundamentally, they're very strong. A strong balance sheet. I think this is a short-term issue. I think will be mitigated shortly. So, First Bank, they recently raised about $300 million in Tier 2 capital. That will come in and help them buffer what they're going through. Skybank, we like Skybank. I think that currently, and I think it's been oversold. Like I said, fundamentally, these companies are very good. On the consumer space, we like a lot of the local consumer players. So USCN, Flour Mills, we like what's going on, what they've been doing. They've been invested in the company, acquiring companies, expanding, backward integration, in line with what the federal government wants them to do. Industrials, we like WABCO, we like Dangote Cements, just because, like I said, they're part of the whole infrastructural development of our country. So, the multinationals, I'm a little bit on the fence with them. I think they're overvalued right now. The growth on the top line, we're not seeing it. And of course, they're being squeezed on the bottom line. But because they're multinational, they're very defensive. A lot of international investors like them, so they tend to put money in there also. So I think, overall, there's some opportunity we see in the market, and I think people can need to sit back and see who is fundamentally strong and place their bets in there.
So that's what investors will be focusing on, those companies with strong fundamentals, even though they're taking a hit from all the headwinds at the market.
Exactly. I think I still think there's upside in a lot of these names.
Okay, so going forward, it looks like it would appear that the market has had its good times earlier in the part of the year where we saw the All-Share Index returning as much as even over 40%. Now we're down to around 27% year-to-date return. All-Share Index has now fallen to around 35%, and it could go even lower. So we don't know what the Q3 numbers are going to look like, particularly for the banks. But do you think that this could actually has the potential to continue for the rest of the year?
Well, Q3 for the banks might be a little bit shaky based on what we've seen with NIBOR right now. So, but I think by the end of the year, another thing also I didn't mention in regards to the banks is that the AMCON levy is due. So that's one reason also that's put in the squeeze.
That's another debit for the banks.
Debit for them. So they've been keeping that money in place. Hey, we can't touch this. It's going to the CBN. Going to AMCON. So that's also one of the reasons why we're seeing the NIBOR rate go up a little bit. So, but I think once that's out the system. Like I said, the other funds they've been raising, the Tier 2 capitals that some of those banks are raising will help mitigate that. End of the year, I think, I still see upside some of those banks, and I think, and some of the savings for them, they're probably going to get some cost control from a lot of those banks.
Okay.
Exactly.
All right.